Good evening, class. Tonight we're going to be covering Chapter 11, Cost Behavior and Break-Even Analysis. This is for ADMN 2556, Finance and Accounting for Non-Business Majors here at the Sault Ste. Marie campus of Algoma University. My name is Ryan, as you know, and I'm going to be taking you through this lecture. So from the beginning, a couple things that we are going to cover. Basically, your learning objectives and what you should understand by the time we get to the end of this lecture. So you should be able to describe and explain why, or basically an understanding of cost behavior is important, and why you should understand how costs behave when doing different various forms of analyses, how variable costs behave, fixed costs behave, and putting that together, total cost behavior as well, usually in kind of more of a formula base. And then how to analyze mixed costs that have, say, maybe variable and fixed components. We're also going to talk about, how fixed and variable costs occur in different cost centers, how revenues behave, and how fixed and variable costs and revenues are combined in a break-even model to basically determine, at what point is our profit zero, which means we have basically covered our fixed costs with our revenue less our variable costs. That is known as our contribution margin, and how we must calculate this and use this for the purposes of doing analysis on our operations. So, high level before I even really get into this, if you want to open a small business one day, when you go and you try to do that, say, bank loan application or whatnot, the bank's probably going to want to understand, okay, how many units do you have to sell before you're going to break even on your operations, right? If you're selling any type of widget, what be a, electronic device, whatnot, and you do your break even analysis and it comes out to something crazy like, I have to sell 50 or 100,000 units, right? Just to simply break even in my first year. That's not nearly as strong as if you were to come up with an analysis and then you said, oh, we think we can sell 5,000 our first year based on market variables, and to break even, it's only going to require 2,000 units, right? So a lot of times, a break even analysis, once you have your cost structure in place, is the first step in understanding, how viable and how realistic your actual business plan might be. So as an intro, organizations, as we know, are basically bound by some constraints. So prices of the products are constrained by customers' willingness to pay, right? Not necessarily the case when it comes to coffee, as research has shown. When you basically are setting a price for coffee, when you raise your prices of coffee, it's shown that demand doesn't normally actually react. So it's called usually inelastic. It means consumers are not sensitive to price changes. Whereas in kind of like the soda industry, any slight change in the cost of Coca-Cola, Pepsi, stuff like that, consumers are likely to change from one product to another because there's a lot of options out there. So depending on the industry, we have to deal with constraints of our customers of what they're willing to pay for our products. And the quantity they sell is limited by customer demand, right? So we can only sell as much as people are willing to buy, and by the actions of our competitors, right? Whether our competitors decide in that case, right, they're going to drop their prices. So the competitors might sell more products than us, and do we react and do we drop our prices as well? So costs are constrained by the prices and availability of raw materials as well, right? And as well as labor in the labor market. And then within those constraints, right, we have how much we can sell, and then all the different variables of kind of how much we can produce and the raw materials are required. And you put that together, and organizations are engaged in making plans around all of those constraints to be as profitable as circumstances may permit. So a good understanding of the reasons that underlie cost behavior is necessary to do this properly. Understanding cost behavior is the basis of making accurate plans and budgets for operational activities, and it also facilitates effective budgetary control. So we'll start with a simple model. All costs can be treated as being either fixed or variable. You might say, sir, and we talked about this a little bit last class. What about electricity costs, right? There's usually that fixed portion in the electricity where you have to pay a delivery charge pretty much no matter whether you use any electricity or whether you use, a whole bunch of electricity, right? And then there's that variable portion that you usually pay, say, per kilowatt hour. We're going to put those types of costs aside, and we're just going to basically focus on variable costs that change with units of production, units of sale, right? variable because they increase and decrease with sales. And then we're also going to talk about fixed, and fixed simply don't change, right? So there may be other more complex, but we're going to stick with these just for simplicity of the gate. When combined with expectations about sales revenue, a simple model of cost behavior enables managers to use cost, volume, profit, or CVP analysis, right? To basically plan out our operations so that the organization is as profitable as possible. So cost, volume, profit analysis also enables managers to understand the effects of changing various aspects of their business plans. Um, and simplified assumption that all costs are capable of being described as either, say, fixed or variable is quite adequate when dealing with simple organizations. As we move on to, say, more complex organizations, this becomes less and less true, especially with those mixed costs. But when you're first starting out, a very simple fixed versus variable cost model can usually give you somewhat, accurate analysis as to, what your performance should and shouldn't be. So a retail store that sells a single type of product is good, right? Because you're only dealing with one type of product, that's one variable cost. So whatever you pay for it is basically the variable cost per sale, right? And then say maybe your overhead is like, the rent that you pay on your store, right? So as they become, more complex, you sell more different types. Maybe you have services and you also have products at this point. Each one has, a different variable cost, right? And then your fixed costs become more complex over time too. This simple application tends to fit less and less. So for these situations, it's necessary to treat costs as being caused not by just sales volume, but by a more complex mix of activities. And this is kind of what activity-based costing is in Chapter 12, a far more complex version of cost volume profit analysis. So cost behavior describes the relationship between costs and different levels of sales activity. So when sales goes up by $1, what does our cost go up by? The two main different types of cost behavior that we're concerned about are fixed costs and variable costs. Mixed costs contain elements of both, like I described with electricity costs, and the two parts of a mixed can be separate so that they can be slotted into, like, say, either fixed or variable. So say like that fixed charge in electricity costs, right? The one that you pay no matter what, the delivery fee versus how much you pay per kilowatt hour would be, say, the variable cost per kilowatt hour, right? So variable costs are incurred in direct proportion to sales levels, right? So the more you sell, the greater the variable costs. If sales quantities double, then your variable cost should also double proportionately, right? By definition. So in statistical terms, a variable cost is positively and perfectly correlated with sales activity. So for instance, right, we are selling, let's say tape. Actually, you know what? My marker here, okay? This marker, I sell it to people for $1. I spend, say, 40 cents to acquire this marker, right? So if I want to sell two markers, I have to buy two markers, right? So I sell two markers, that's $2 in sales, right? But each of these, to sell a marker, I have to buy a marker. That's my variable cost, right? And say each of these cost me 40 cents, I would have $2 in sales and then 80 cents in variable costs. The second I sell one more marker, I'll bring on another marker into my sales, but I'm also going to bring on another 40 cents in cost, right? So it's perfectly correlated, right? So the slope, if I were to plot that out, would be 40 cents. Every time my sales goes up by $1, my cost goes over by 40 cents, right? And that's what we talk about by perfect correlation, is there's a constant relationship between what I sell and the costs incurred because they go up at the exact same rate. So variable costs will include the following: cost of goods sold in a retail outlet, raw materials used in, say, a manufacturing company, production labor, right? Some overheads, maybe power supplies, as we talked about, per kilowatt hour, and sales commissions, right? Why are these all variable costs? Well, let's think about it, right? Again, if I want to sell a marker, right, I have to buy a marker. That's cost of goods sold. That's cost of, basically, in order to sell, I have to buy more of these, and then when this will become cost of goods sold when basically I sell the inventory, right? If I want to produce, say, in car manufacturing plant, I want to produce more cars, I'm gonna have to buy more tires, right? I'm gonna have to buy, say, more aluminum, all the engine components and whatnot, more windshields, everything, right? I can't produce more cars without purchasing more raw materials. So therefore, my variable cost has to go up in order to sell one additional unit worth of cars, and it should go up on the same basis, right? Because Generally speaking, within a fixed term, our cost per car should be relatively constant, right? Until we get into, say, concepts of economies of scale, maybe in our more long-term decision making. And then production labor, can't produce in our car unless I have people on the actual line, running the actual line, right? So, and then sales commissions, a lot of times salespeople won't make sales for free. So if I want to make new sales, well, a cost of that is I have to pay my salespeople an incentive in the form of commission, right? All going up, every single dollar in sales, right? There's a specific proportion of those costs, whether it be, cost of goods sold, raw materials, or sales commissions. They also have to go up by a certain amount to drive those sales, right? So for planning and control purposes, it's necessary to understand the variable cost relationship. And the higher the level of sales activity that's planned, the higher the budgeted variable cost will be, right? So the higher the level of actual sales activity, the higher the expected variable cost will be as well. So Leon's Furniture, for instance, is a furniture retailer, and I believe we actually have one in town here, and has a dining room set inventory, and it's priced at $800. Okay, so price. This is what we're going to sell the dining room at if someone bought it off our floor. Okay, and the cost of this was $448. So that means that that piece of inventory, assuming it's not consignment, right? We bought it for $448, and now, and that's what we paid when we acquired it from whatever wholesaler or manufacturer. And now we have it sitting and we're trying to sell it for $800, right? So if Leon sells that dining room set, in order, to bring its inventory back up to the previous level, it would have to go buy another one, right? So that dining room table is now basically off our showroom floor, and you know what? We want to sell more of them, right? Because we're clearly making a half decent margin here, right? Over $200 per table, over 252 per table, right? So in that case, if we want to basically sell another one, sorry, my math is off today, long day, about 352. So if we want to sell another one, right, what we have to do in that circumstance is we have to basically purchase another dining room set and put that onto our showroom, right? So, and that's going to cost us another 448, right? So every time we want to make an additional $800 in sales, specifically on dining room sets, it's going to cost us 448 to buy that dining room set. So the 448 is truly a variable cost because every time our sales goes up by 800, there's a relationship that our cost goes up by 448. Here's what that would look like, right? Let's extrapolate that and say, assuming that maybe Leon's is only selling those dining room sets, right? And that, or across our entire sales operations. In this case, the gross margin on this dining room set is 44%. If you remember from like our previous discussions in the financial statements, gross margin is basically simply calculated. I'm going to use a darker color so that there's a little bit more contrast. But if you take your sales, right, and our sales in this case is $800. And then we know that our variable cost, right, or our cost of goods sold maybe, cost of goods sold, right, because it's inventory, is going to be 448, right? So in this case, what we're going to get is we're going to get 352, right? And this is going to be our gross profit, right? So in order to get our gross margin, we just take this 352, right? So to get our margin, we very just simply go that 352, and we divide it by the 800, and that is going to get us that 44%, okay? So in this case, our gross margin is 44%. Every time we sell something for $800, 44% of that is gross margin, and then the other 56% of that is cost of goods sold. Okay, so I can actually put that here, so it's easier to track. So 56% would be your cost of goods sold, and 44% would be gross margin. Okay, so in this case, right, what we're basically doing in this example is we're assuming that from the dining room set to the recliners to basically every different thing, everything has a gross margin of 44%, right? Whether we're selling it for $100 or $1,000, right? If we're selling it for $100, then we make $44 in the sale. If we're selling it for $1,000, we would make $440 on the sale, right? Because that's 44%. in gross margin. So what we're doing is we're assuming that across the entire store, on average, we earn about 44% every single sale. That would mean that, when sales is zero, we have no direct costs, right? Because why would we have direct costs in this case? Because our costs go up the same rate as our sales. So when we have costs of when we have sales of 800 million, we would assume that our direct costs to associate to create those sales would be 448,000, right? Because in order to sell 800 million worth of inventory, we would have to buy 448 million worth of inventory to even have it available to sell to the customer, right? Say we double that, we go up to 1.6 billion dollars, right, in sales. Well, we're going to need 896 million dollars worth of inventory, right, to do that. And it's at the exact same relationship because it's going up in a linear basis. And then to sell $2.4 million, right, in sales, we would need 1.34 for billion in inventory purchased, right? So what's happening here is every time the sales doubles, the direct cost doubles in perfect proportion, right? Every time sales goes up by $1, direct costs going up by 44 cents, right? So when we say we tried to map this out, what this would look like, and I just have to make sure you're able to see this, is this would look like as follows. And this would be, say, your sales, right? And this would be your variable cost down here. What's happening is every time my sales goes up by $1, right? Sales goes up by $1, my variable cost is basically going up by 0.44, right? So at any, sales level, I can basically calculate what my total variable costs would be, right? Because it's a constant relationship that we're assessing here, a linear relationship, right? So if you can't see what I'm drawing back here, don't worry, my drawing skills are not great. That's why I'm an accountant. I didn't go to art school. But you can see what I'm drawing here in a lot better detail. So we know this that's a completely linear relationship. When my sales double, my variable costs double. And if you go basically rise over run, right? They did it the other way, so they did direct costs as the as your x-axis, or sorry, as your y-axis, and then your sales as your x-axis, right? So in this case, when you do rise over run to calculate the slope of a line, right? So you go x2, sorry, in this case, you would go y2 minus y1 divided by x2 minus x1. What you would get is that 44 cents. It's the relationship, right? So when sales goes up by $1, direct cost goes up by 44 cents, and that's what we see here. Every time our sales goes up, say by another 800 million, our direct cost is doubling proportionately, and our direct cost always remains constant at about 56% of our sales dollars. So fixed costs now. The behavior of fixed costs is the opposite, right? Sales dollars go up by $1, fixed costs remain exactly the same because by nature, they are fixed, right? They should not change. So changing, the level of sales activity does not alter these fixed costs, and they are constant at all activity levels. So Leon's Furniture incurs approximately 825 million in 2018 in selling general and administrative expenses. So let's assume that say 40%, hence 330 million, are general and admin expenses. That would be incurred each year, no matter what the level of sales for Leon's managed to make, right? So actual sales were approximately 2.241 million in 2018. But if the sales fell to say, sorry, this is 2.2 billion. But if sales fell to, from 2.2 billion to 2 billion, or rose to 2.4 billion, basically what you would expect is that the general and admin expenses would not change, right? So that 330 million, whether we go up to 2.4 or down to 2 billion, that 330 million should stay exactly the same. Whereas your selling cost, that's a lot of commission. We know commission goes up and down with sales because our sales staff make a percentage of our sales, right? So it's perfectly related. So here's an example of that. Our sales going from 0 to 800 to 1.6 to 2.4 billion, right? Our general and admin expenses, they're fixed. They don't change. They just stay constant at 330 million. I'm not going to graph it out because it's on the next slide. I remembered this time. But this is what it looks like, right? Whereas on the x-axis, we have our sales, and our sales remain constant, right? Sorry, our sales not remain constant, but no matter how much our sales increase, It's our general admin expenses that basically stay constant at 330 million. Here's some examples, right? Advertising, rent, property taxes, depreciation. So for instance, usually you set your advertising budget for the year and then you execute, right? You don't change your advertising budget. It's very hard to actually establish a connection between your advertising expense and your sales, because a lot of times you may, enter into an ad campaign or whatnot, and you can't really tell when it actually became effective, or you know, what campaign, or what sales tactic from like social media to maybe in-person promotions, or which one basically influenced the consumer to buy. The only way you could possibly know is if you went and you did a detailed psychological assessment of the consumer to figure out why they bought your product, and you just can't do that, right? And half the time people really hate filling out surveys. Think of the last time, someone said, "Oh, you bought my product. You want to fill out a quick survey?" And most people go, "No," right? Every time you're asked to do my evaluation, right? I'd say 90% of my students don't do my teaching evaluation, right? So in that case, it's impossible to know, what necessarily drove the sale. So in that case, we consider them fixed. You set your plan and then you execute, and then whether your sales are, after that, you're still keeping your advertising constant what your planned rate was. So same, with rent, you usually lock into a lease for a certain amount of time, and that lease doesn't usually change based on your sales. Property taxes, you're usually not telling your local government what your sales are, and they're usually not adjusting the property taxes. It's usually a constant rate. Depreciation, interest expense, it's unrelated to sales, right? It should remain constant. And then your staff salaries, outside of commission that's paid, but your admin staff, your accountants, your HR people, all those people, basically they should remain relatively constant, whether you have like no sales or whether you do, 3 billion sales, right? So fixed costs may be treated as capacity costs. They give the organization the potential to carry out their business activities. And all other things being equal, organizations will try to manage their fixed costs to be as low of a level as possible. So, however, they will not want to reduce their fixed costs below a level where they provide enough facilities to enable the planned business activities. So total cost, using the simple model of cost behavior, total cost will be the sum of your fixed cost plus your variable cost. So when we put that flat line, right? So usually that would be like your y-intercept if you're familiar with math, and then you add on your variable cost, right? What you get is you add your fixed to your variable, and then up here it would be your total cost, as we'll see graphed out, which is coming up. So here is the table for fixed costs of 306 million per year and a variable cost. Okay, so they're using 57% difference in rounding. But basically your fixed cost remains the same. Your variable cost goes up, as we showed in that graphic example, right? And when you add your fixed to your variable, what you get is your total cost. When we, graph that out, basically what we're doing is we're combining the lines. So we have our fixed cost line at 330 million, right? And now we start our variable costs at where those fixed costs start, right at that 330 million. And then basically it takes off. So our variable cost line starts at 0 and goes up with sales. Our fixed cost line stays constant at 330 million. And our total cost line starts at 300 million, 330 million, and then goes at the constant rate of variable costs, as we see here, right? The combination of those two lines to come up with the total cost line, which is right here. So we continue on. Now we talk about mixed costs. So some costs do not fall neatly into either the variable costs, or a fixed cost category, because they contain elements of both. We talked about delivery charges on electricity, and then, adding on, what do I get charged per kilowatt hour? So the cost of, say, operating a delivery truck is a combination of fixed costs, including insurance, registration, amortization, and then there's also variable costs, which include, say, fuels and repairs, right? So normally set your insurance stays pretty constant through the year, no matter, even if you don't drive your truck, you're still paying that insurance, right? But the more you drive your truck, the more you're probably gonna have to pay in repairs, and the more you're gonna pay in fuel. Unless you buy a Tesla, then you probably don't have to pay very much in repairs or fuel, right? But electric infrastructure isn't quite there yet for the commercialized electric transport, right? So suppose Leon's Furniture Limited, use trucks to deliver furniture to customers. The furniture retailer expects that some part of the truck's operating expense would be fixed and some part would be directly related to sales, right? But we don't really know how much. All we know is that our total shipping, truck costs goes up with sales, and we know some parts fixed and some parts variable, but we don't know the fixed portion, we don't know the variable portion. But we do have two data points, right? And if you remember any type of like linear algebra, you're probably seeing where I'm going with this. So in January, total sales were $15 million and truck expenses were 1.25 million by the looks of it. Okay, and then February, sales rose to 17 million. So that's a rise of $2 million in sales, okay? So if our sales is the x-axis, we went over 2 million on the x-axis, okay? And then our truck expenses rose to 1.35 million. So very interestingly, when our sales go up by 1 million, when our sales go up by 2 million, our truck expenses go up by 1 million. Okay. It sounds like, and I'm doing a little mental math here, that kind of sounds like every time we enter in, say maybe 1 million more in sales, right? That we basically have to, or say, $1 more in sales, maybe our truck expenses go up by 50 cents, right? Where am I getting this from? Please tell me there's a half decent eraser here. Okay, so if I were to plot this out, right? And maybe I'll get some colors going to make this fun. Fun, it's math. But here we are, right? And down here is going to be our sales. And over here is going to be our truck expenses. Okay. So say about here is we have $15 million in sales. Okay. And I'm going to say right about here is where we have 1.25 million in truck expenses. Okay. So from right here is a data point, okay? And this is our January truck expenses and our January sales. And then I find out that basically at 17 million in sales, our truck expenses are 1.35 million, okay? So in this case, I plot this out to about here, I plot this out to about here, okay? So what has happened here is basically this is an increase, right, of $2 million from January to February. And this is an increase of, oh, sorry, my math was totally messed up. That wasn't a 1 million increase. It was a 100,000 increase. So please ignore that 50-cent analogy. It's probably closer to 5 cents. Anyways, my bad. So anyways, it goes up by just a simple 100K, okay? So every time my sales goes up by 2 million, my truck costs seem to go up by 100K. So because I now have two data points, when I connect these two data points, right, I can see a slope of a line, right, between the two. And I can assume that this would carry on to the foreseeable future, right? But I can also assume that this is going to come back and it's going to cross over here. So if you remember my other line where I had fixed and variable costs, my fixed cost remained constant this way, right? And then my variable cost started at the fixed cost point and then increased, right? So if I go backwards between these two data points and I go back all the way to when it crosses the y-axis, which is my truck expenses, right here should be my fixed cost, right? Graphically should be the fixed cost, okay? Okay, so, you know, on exam, you're definitely not going to sit down and draw out this graph, right? Like I just did where, oh yeah, and then I take a ruler and then I say, oh, this looks about 750K. Yeah, you're definitely not going to do that. What you're going to do is you're going to take more of a mathematical approach because chances are it'll be multiple choice and chances are I'm going to put all my multiple choice nice and close to each other so that this method doesn't work. So how do we figure out what is our fixed cost and what is our variable cost when it comes to our truck when we have these two data points, right? So, and I think this just summarizes everything I just said. Hey, 5 cents. So I was off my initial, but I corrected it in my head. So both January and February truck expenses would be made up of a combination of fixed costs and variable costs. We would expect the fixed costs to be identical in both months. And then if we deduct the January total truck expenses from February total truck expenses, right? They would basically the January, right, total truck expense would basically the fixed portion would wipe itself out, right? If I go January fixed costs, right, or are they going? So if you go January fixed costs minus February fixed costs, the fixed costs don't change between those 2 months. They're the exact same, right? So if I subtract them, the fixed portion is going to completely wipe itself out. And then what it should leave us with is the variable change between the two, right? So we will also find that the variable cost of operating trucks in January, when sales were 15 million, would be included in the variable costs of operating trucks in February, right? So we also wipe out the variable costs associated with producing, 7 or 15 million, right, worth of sales. So we get the incremental increase from 15 to 17 million, right? And that is the 100K in truck expenses I was talking about. So what we are left with is the variable cost of operating the trucks is the difference, right, between the January sales and the February sales. So the variable cost of $100,000, which we've identified right here, right, the increase, right, is was basically caused by the additional $2 million of sales that we generated in February. So this enables to calculate the rate of the variable cost. So we have a 100K increase and then a 2 mil increase, right? So again, if I go rise over run, right? So I go, x2 minus x1. So I go basically 1.35 million minus 1.25 million, right? And then I divide that by the 17 million in sales minus the 15 million in sales. What I'm going to get is 100K divided by 2 million. And then after that, I'm basically going to get 0.05. This means that every time my sales go up by $1, my variable costs are going up by 5 cents. Okay. So what I've basically done here is I figured out, what is my variable costs, right? But I haven't necessarily sorted out my fixed costs. So for anyone that might remember, the equation to calculate the slope of a line, you might remember y equals mx plus b, right? And what y equals mx plus b basically means is this. Uh, Sorry, that should be lowercase. Mx plus b. And what that basically means is that this is normally your y-intercept, right? And then this is usually your x-coordinate, right? Or, the coordinate on your x-axis, which would be basically our sales amount, right? Your x value. And then m is the slope of the line, which is what we just calculated, right? It's the rate of our variable cost. And what this means is that if we have the slope and we have the y-intercept, so the slope is this, right? The 5 cents, the variable cost rate, and we have this y-intercept over here. When we punch in any x coordinates, so we say our sales is 18, 19 million, the resulting number that should come out would be, what is our truck expense at that level of sales. So in this case, right, y equals, so we have the slope, which is 0.05, but we do not know, right? We do not know what our y-intercept is yet, right? Because we haven't quite figured it out. But the good thing is that we actually know a coordinate, right? So we know what the slope is. We know what the sales level is in February of 17 million, and we know at that point in time our truck expenses were 1.35 million. In this case, it looks like they're actually using the January point to solve. So what we're going to do is we're going to fill this out. So we're going to use this point right here. So we have $15 million and we have 1.25 million truck expenses. This is the y-axis, right? This is the x-axis. So what we're going to do is we're going to fill in this 1.25 m for the y value, 1.25, right? And then it's going to equal 0.05, right? And that's the slope. And then we're going to multiply it by the x coordinate, which is 15 million, right? So punch in 15 here, right? Plus b. So what we have is we filled out the entire equation with numbers except one variable. So we can solve for all this and it will give us basically what our y-intercept is, which would be our fixed cost point. So in this case, let's do the math. We are going to go, well, we know this stays the same, right, for now. So we'll go 1.25 million, but we're going to multiply 0.05 by 15 million. That's going to get us 750,000. So 750,000. We'll go 0.75 since this is in millions, okay? Plus b. So now we need to move the 0.75 over to the other side of the equation, right? And basically because when this crosses over, it will go from being a positive to being a negative, right? So when I do that, it's going to be 1.25. So b is basically going to equal 1.25 minus 0.75. So b is basically going to equal, when we do the math, right, 0.5. That's in millions. So that means that this point down here where my line crosses, right, down here is 0.5 million. So that means this would be my fixed cost line here, and then this would be my variable cost line, right? So the slope of this is kind of my variable costs. So if you didn't catch that, I hope you can at least see right here where they basically solve for that. I gave you the more mathematical side of, why, right, using the actual the linear equation, right, of a constant line, right? Whereas, my total cost would be, y, right? So equals your fixed cost plus your variable. So in this case, what they're doing, well, they're flipping it around a little bit. So they're saying, no, my total cost can equal my fixed plus my variable. So I know what my total cost is, right? And that's 1.25, right? And then I'm going to say equals, my fixed plus my variable cost, which is the 15 million multiplied by the 5 cents. So that means 1.25 million will equal my fixed cost, right? Plus the $750,000, which is the variable cost, right? I know my variable cost is at 5 cents per million or per dollar I spend, which comes out to $750,000 in variable costs on $15 million in sales. So when I move that over to the other side of the equation, what I get by going to 1.25 minus the 750,000 is basically the $500,000 in fixed costs, right? So this is more the this is the mathematical approach if you're familiar with algebra, right? And then this is how it works out and how we do the calculations with the lines. But if you want to kind of put that aside and you want to take more of a kind of a logical approach, again, total truck expenses, right? A total truck expense, we know it equals the fixed line plus the variable line. Well, we can calculate our variable costs by simply just going that rate that we calculated, right? The 100,000 divided by the 2 million gets us 5 cents. And we know so that if we go to 5 cents, right? Because, we basically have variable costs of 5 cents per, sales dollar. 5 cents multiplied by the 15 million gets us our total 750,000 variable costs on the truck. And then process elimination, total cost minus the variable cost, it gets us the fixed cost of 500,000. Hopefully this made sense. Okay, so here's the disclaimer, right? This is finance and accounting for non-business majors. Maybe you'll save this part of the recording for when you want to take a little nap later, because it was algebra. But at the end of the day, many of the managers whom this book was written for, will be operating service departments, right? And such as marketing department or human resource department. So in service departments, it's common to find that most costs are like fixed costs, and their costs do not increase automatically because sales levels increase. So generally speaking, like if you're operating an HR department, all your costs are going to be fixed. You don't have to deal with this, right? Your cost line is just going to be flat, no matter what sales does, right? Your fixed cost remains the same. So they'll include like staff salaries, employee contributions, pension plan, rent, property taxes, all these different things, because you're expected to still deliver your service to the rest of the organization, no matter how much sales increases or drops. And then it's possible that in the long run, increased sales levels will basically make all the service departments busier, and it may prove necessary to increase the service department's budgets. So, say in the long run, maybe your budget will increase with sales, right, as sales increases. But in the short run, the idea is that your costs would be fixed and that they shouldn't fluctuate too much with increases in sales. So, now, how revenues behave. So it's always assumed that revenues are purely, a variable item. That is, the selling price is constant per unit of product sold, no matter when or where the sale occurs, right? And no matter who the customer is. So we try to keep that sales unit constant. In truth, this isn't true. You get bigger, customers, say like Walmart, you're going to give them a better price per unit, right? Rather than the smaller, a buyer that's only buying, say, like 2, 3 units from you, you know, bulk discounts basically. Yeah, as it says, sorry, I jumped ahead. It's a considerable simplification, right? In the actual, situation where products may be sold at a higher or lower price to reflect the additional cost of servicing, distant markets, right? If you have to ship further, you may raise your costs as well. So in economics, for example, the normal expectation is that sales revenue per unit will start to fall off relatively high and then gradually reduce, right? Start off relatively high and then gradually reduce as the product is sold to customers who are only prepared to pay, a lesser price, right? So if you think of like the iPhone when it's originally released, right? Over time, it's gonna be sold, right? It'll come out as a premium, and then over time, the price of each phone kind of comes down, right? Especially as newer phones come out, people aren't willing to spend as much on the phone. Market skimming. So, for the purposes of this chapter, those complex patterns of relationships between selling, price and quantity will be ignored. We're just going to assume that sales revenue is linear and indirect proportion of sales quantities for learning purposes, so that you can at least understand this model. Once you understand the model, sure, as things get more complex, you can take this model and apply it to more complex situations and make more complex assumptions. But for now, for learning purposes, we're going to assume a fixed rate. We can combine the features of variable nature of sales and variable costs and the fixed nature of fixed costs into a model that is called the break-even analysis, or the cost volume profit model. So this is a simple way of looking at the relationship between costs and revenues and its impact on profit levels. It allows us to determine the answers to questions such as, what level of sales is necessary to cover fixed costs, right? To avoid making a loss. So at what point, when you first start, usually you have your loss, and then you sell more, and your loss gets smaller and smaller and smaller. And then at some point, your profit is zero. You don't have a loss, but you have a gain. What is that point? That's your break-even point. And then what level of profit will be achieved by a given volume of sales, right? So say, okay, we broke even at 200,000 units, right? What if we sold 500,000 units? What would be our bottom line, right? And you can kind of understand, how much your profit increases, when you take on, additional levels of, unit sales, right? And then what would be the marginal effect of changing factors such as your selling price, your sales volume, your variable costs or your fixed costs, right, on the level of profit, right? So if I, have less leverage and I have less fixed costs in my operations, how much more profitable can I be? If I could shave 5 cents off, my cost per unit, what impact would that on, say selling 200,000 units, right? And what would be my bottom line as a result? This can answer all of those questions. And it's a simple but powerful tool when applied correctly, because it gives you an idea of, is this business worth growing, right? Even if I built this business to 100,000 units of sales, could I still sustain myself, right? It gives you an idea of, like, the products that do have really high margins that when scaled are totally worth it and you can aggressively grow, versus the products that, you have to work really, really hard to sell a whole bunch of units. And if your profit doesn't go up much, it's probably not worth it, right? Maybe you want to consider something else. But if you do this planning out of the gate, you won't do all that work and then find a layer that wasn't really worth it, right? So contribution margin, when goods are sold, revenue is generated, and then the sales cause variable costs to be incurred. So the difference between the selling price per unit and the variable cost per unit is called the contribution margin per unit, right? The contribution margin per unit measures how much better off the company is as a result of selling one additional unit. Conversely, the contribution margin per unit measures how much worse off the company is if sales are reduced by 1 unit, right? The idea of the contribution margin, when I go sales less my variable costs, and I get that contribution margin, it's basically the margin left over to contribute to paying off my fixed costs. Then when I eventually do pay off my fixed costs, right, it starts contributing to my profit because I start exceeding my fixed costs. So just as a recap, right, what this looks like is this. Oh, so I go my sales, right? And say my sales are, I don't know, $1, right? And this is on a per unit basis, right? I'm using some of my original numbers. And then I'm going to say my variable cost, right, is going to be 40 cents, 0.4, right? That would leave me with a contribution margin of 60 cents. And that would mean, every time I sell 1 unit, right, I generate a sales dollar, right? I incur variable costs of 40 cents, so that contributes 60 cents to my fixed costs. And then, reduces my losses by 60 cents and eventually will become, net out to zero when I break even, and then eventually will generate a profit at, 60 cents a unit. But we'll go through an example and I'll show you how that works. Okay, so this is Tony. Tony decides that he wants to sell coffee, tea, and soft drinks, right? So each drink is priced at 80 cents and has a variable cost of 50 cents. Okay, and the contribution margin is 30 cents per drink. And for every drink sold, Tony will basically generate an additional 30 cents. Okay, so let's fill in these numbers and let's use that as an example. So I have and this is where it's nice to have students in class because they can help me with these numbers as I fill them in, but I will survive. So we have 80 cents, right, per unit. That's going to be too light. We'll switch back to black marker. Sorry. So we have 80 cents per unit. It's like you can see. Yep, 80 cents. Yep, you can definitely see. Okay, so 80 cents per unit, right? And then it's saying that our variable costs are 50 cents. Yeah, 50 cents. So we're going to take off variable costs of 0.5. And that means what we have left over is 0.3, right? So we basically make, every time we sell a, pop or whatever, we are earning 30 cents a unit. So if we sell 1,000 drinks, right, are sold in a day, basically the total contribution margin would be $300, right? We sell one more, right, at 1,001, our contribution margin is going to go up by 30 cents, right? Because it goes up by basically 30 cents a unit, right? So again, contribution margin on 1,000 drinks would be basically the $1,000, right? Multiplied by the 0.3, the 30 cents, that would get us to $300 in contribution margin. And every time it goes up by one, our sales goes up by $1, our contribution margin just simply goes up by 30 cents, okay? So let's consider a break-even point, right? At what point do we basically go from a loss into making profit? So once variable costs are subtracted from sales revenue, the amount left behind is the contribution margin, and the contribution is basically used to pay for the business's fixed costs. So when that has been achieved, the business has reached its break-even point. It's basically useful to know this, your break even, because if this level of activity is unlikely to be reached, there's no reason for the business to exist because it's unlikely you're going to make any profit. That's the whole point, right? Unless you're not for profit. And then knowing the break even enables a sensible decision to be taken as to whether or not to go ahead with a business venture, as we talked about in the opening slides. So to calculate the break-even point, the fixed cost for the given period of time is divided by the contribution margin per unit. So the answer indicates basically how many units need to be sold in that period to reach the break-even point. So Tony's Drinks has fixed costs of $180 a day. So, Tony sells 0 drinks in a day. He's still incurring $180 in costs. Maybe that's driving costs or setup costs or whatnot, right? Advertising maybe, right? But he's still going to incur $180 whether he sells, 1,000 drinks or sells 0. Okay. He's selling 80 cents, right? Well, he's selling each drink for 80 cents, and his variable cost is 50 cents per drink. So his contribution margin is 30 cents, as we established up here. So we're coming up with a break-even point of 600 drinks per day. What is that? Well, when we calculate break-even point, right, what we're actually doing is we're just going, so our break-even point is basically equal to our fixed cost, FC, divided by our contribution margin. So in this case, our fixed cost is $180, right? And our contribution margin is 30 cents. And when I do this calculation, this gets me to 600 drinks because That 30-cent contribution margin is how much I generate, right? How much excess I generate on every time I sell a drink, right? 30 cents. 30 cents goes into $180 600 times. So I'd have to basically, 600 drinks would contribute $180, right, in contribution margin to basically wipe out my $180 in fixed costs, right? If I were to, do an income statement, it would look a little something like this, right? So we're going to do 600 drinks at zero point 0.8, right? So my sales, right? So I'd have sales, I'd have variable costs, right? So what I'm going to go is my variable costs are 0.5. So 600 times 0.5 is $300. And then I know when I subtract this, I'm going to get 180 because that's my contribution margin. So 300 plus 180, 480. So my sales would basically be $480. I would subtract off $300 in variable costs, and then I would get to my contribution margin of $180, right? And then I have my fixed costs, right, of $180. I take those off, and then my profit at the end of that would be $0. Okay. That's your break even point when your profit is $0, right? And that's what we've basically calculated here is, how many units do I have to sell for my profit to be zero? Well, I have to sell 600 units at 80 cents, right? Times 0 0.8. And then that is going to cost me, right? So 600 times 0 0.5, right? Because 50 cents per unit, right? And then that's going to get me a contribution margin, which is 600 times 0 0.3. This is completely has nothing to do with my level of sales. It's fixed, so there's no calculation here, right? And then it gets me to zero. All right. So if Tony sells, less than 600 drinks, he's gonna have a loss on the day. The second he sells more than 600 drinks, right, he's gonna have a profit on the day, right? So if Tony sold 601 drinks, right, his sales would go up by 80 cents, right, to $480.80. His variable costs would go up by 50 cents, so he'd have $300.50 in variable costs. Therefore, he would have a contribution margin of $180.30 because of the additional sale. His fixed costs would remain exactly the same, and at 601 units of sale, he would have a profit of 30 cents, right? Because now the contribution margin's basically contributed and paid off the fixed costs, and now it contributes to the bottom line because it starts to increase our profit. So here's what that looks like, right? We have our sales revenue going up at a constant rate of 80 cents per unit. We have our total costs that are basically going up at a constant rate of 50 cents per unit. And this point here, right, basically where the two lines cross, what that is that is our that's our break-even point, right? So the distance between the sales revenue line and the total cost line before the break-even point is your loss, right? And you'll notice the loss gets bigger and bigger and bigger and bigger until we hit zero sales dollars. And then at that point, the loss is basically a loss of 180 because that's our fixed cost, right? And then that loss gets smaller and smaller and smaller and smaller as we, basically have more sales, and those sales contribute, 30 cents basically every time we have a sale. And then we sell 600, right? 600 times 30 equals 180. And then now we have $180 in contribution margin to wipe out our fixed cost of $180. That's where this crosses at the 600 units point, right, where the two lines cross. And then after that point, right, now we see the sales revenue is higher than the total cost line. So the space between those two lines, right, as it gets bigger and bigger at like higher sales units, that is your profit, right, is the space between the two lines. And I should have just talked as this went along. But yeah, so this is your break even at 600. So if we were to sell 850 units, right, we would go 850, right, times 80 cents. This would be $680 in sales. Our variable cost would be, 850 units times 50 cents per unit, $425 in variable costs. So our contribution margin would be $255 overall. Our fixed cost would remain stable at 180, right? Because it doesn't change with a level of sales. So our operating profit would be 75 bucks. So Tony has decided that unless he can make a profit of $120 a day, it's just not worth getting out of bed, pretty much. So to make $120 in profit, he has to make enough of the 30-cent contribution margin to pay his fixed cost of 180, and then he also has to gain an additional 120, right? So a total of basically 300 he has to make in contribution margin. So to make this level of profit, he will need to sell 1,000 drinks, and that is 300 divided by 30 cents, right? So let me show you how they're doing that calculation. And you should be able to see over here. Yeah. So what they're doing is they're very simply going their fixed costs, and this is what the formula would be, fixed costs plus your target profit, I'm going to say TP, target profit, divided by your contribution margin. So what they're doing is they're taking the 180 in fixed costs, and then they say, okay, but we have a target profit of 120 per day. So they add them together. This gets them that total of $300, and then they divide that by 30 cents, right? And then when they do that, what they end up getting, right, in this case was, I believe, was it 1,000 units they said? Yeah, they got 1,000 units by basically going 300 divided by 30 cents per unit. So this equals 1,000 units. So let's prove it, right? Over here, we're going to change all of these to 1,000. 1,000, 1,000, 1,000, right? So our sales just became 1,000 at 80 cents, right? So now we have $800 in sales. And we're going to have 1,000 times 50 cents on our variable costs. So now we have $500 in variable costs, right? $500, right? And then 800 minus 500 gets us a contribution margin of $300. Our fixed costs remain exactly the same, right? So we subtract off the 180, and now that gets us to a profit of 120. So, and that's exactly what this calculation did, right? Was it told us if we want to achieve a profit of 120, basically what we have to do is we have to sell 1,000 units because that will cover our fixed costs and then continue on at 30 cents until it creates a profit of 120. And it does that at 30 cents per unit. Okay, so based on his profit expectations, if he cannot sell 1,000 drinks a day, it's not really worth being in business, right? Because his target is he wants to make 120 bucks a day. If he's not making 120 bucks a day, he doesn't want to do it. Fair enough. So if he estimates that he can sell more than 1,000 drinks a day, then he has potentially a viable business, right? If his prediction is that he can sell, exactly 1,000 drinks a day, he is at a point of indifference, right? He's basically making 120 on the dot, not more, not less. So, maybe it's worth it, maybe it's not, right? Maybe that's equivalent to what he's currently making. So maybe he doesn't really care. Maybe he just sticks to what he's currently doing. So if this prediction is that he can sell 850 units per day, then his profit objectives will not be met, right? He'll fall short by basically $45, right? Because at 850 units by these calculations, we would generate a profit of $75 when we really want to generate a profit of $120. This is calculated by basically doing the difference. So 1,000 minus 850, that's 150 units difference. The 150 units difference multiplied by 30 cents, right, gets us the $45 difference in our profit. So here is, graphed out, right, our break even at 600. And then at sales of, 1,000 units, what we have here, right, is our sales at 1,000 units is going to be $800. And then our total cost at that point is going to be 500 bucks. Sorry, our variable cost at that point would be basically 500 bucks. So not 500 bucks. Our variable cost would be $500, but we have to add on the fixed cost, and that's what they're doing with the total cost line. So 500 plus the 180. So our total cost would be $680 in this case. So the 800 minus the $680 is what gets us the 120, and the 120 is basically the difference between these two lines. Sorry if that came out a little confusing. But it's everything we just already did, basically. So using the break-even model to analyze changes, the break-even model lends itself to basically a simple but sometimes very effective what-if analysis, right? Or sensitivity analysis, as we may call it in finance. And it's basically, what if the numbers or assumptions change, right? Or so on and change to basically study the effect of change and determine, what changes could we make in our operations to basically make this more profitable. You might want to consider the effect of, say, increasing the selling price. This would increase the contribution margin, but what will happen to the sales volume, right? So usually sales volume drops if the selling prices increase unless the product is perfectly inelastic, right? So meaning that consumers' buying habits for this product do not change in response to an increase in selling price. So just like, coffee. Or you might want to do the reverse, right? Decrease the selling price, which would basically increase the volume, but decrease the contribution margin. Right? Because when we know that when you basically reduce your prices, usually demand increases, right? And people want more of your product, as we know by the basics, economics, supply and demand, right? So, but it's not in isolation. When you change one variable, inevitably it's going to change other variables. So sometimes the effects are extremely complex with several variables changing at once, and you have to make some assumptions to try to apply these models. So Tony's break-even calculation informs him that he will need to sell basically 1,000 drinks to pay his fixed costs and get the 120 profit he's hoping for. His best estimate is that he can sell 850 drinks per day at a price of 80 cents, which is not enough volume to give him his required profit. So Tony is considering two alternatives. He could raise the price of drinks from 80 cents to a dollar, right? In which case his volume will decrease to 600 units, right? Because as we know, he's increasing his price, and because he's increasing his price, what's basically happening here is demand is dropping, right? Because less consumers are willing to pay that amount, which makes sense, right? So if he raises his price from 80 cents, so he raises, by 20 cents to a dollar, he will only be able to sell 600 units a day. Or he could decrease his price, right, from 80 cents to 70 cents, right? So sell for 10 cents less. And in a day, this is going to boost demand, right? It's going to increase to 1,600 units. So his demand is almost going to was it almost double in this case, right? Because he thinks he can sell 850 at 80 cents. So almost double. His demand's going to go up by 750 units, right? By simply dropping his price by 10 cents. Very interesting, right? So what I'm seeing here is a highly elastic product, right? Where consumers, they react very, very, very quickly to changes in price, and they seem to react quicker to changes and drops in price than than increases in price, which is interesting. But makes sense because I think soda is one of the examples I gave of a very elastic industry at the start where consumers, really respond to changes, right? So selling price at 80 cents, right? Our variable cost remains 50 cents. Notice how our variable costs do not change here. Our cost structure doesn't change. So all that changes is our contribution margin per unit. So in this case, at 80 cents, variable cost 50 cents, we have a contribution margin of 30 cents. This is what we've been doing all along. Therefore, we have a volume of 850 units. So that is $255 in contribution margin. Subtract the 180, right? That gets you to the original $75 we're talking about, which is 45 short of the $120 in desired profit. So if we sell at $1, we're going to have a contribution margin of 50 cents. We can sell 600 units at 50 cents. This is going to achieve a total contribution margin of $300. We take off the 180 in fixed costs off that contribution margin, we have $120 in profit. That's our target. We've met it, right? So if we increase to a dollar, we will achieve our profit objectives, right? But if we drop to 70 cents, our selling price drops to 70%, 70 cents, sorry, our contribution margin is going to drop to 20 cents per unit, right? Multiply 20 cents by 1,600 units of sales, our contribution margin increases to 320. Take off the fixed cost of 180, right? Now we have a profit of 140, right? So in this case, our profit objective of 120 is met in the previous case, but is exceeded here and now is 140, right? So, but we have to consider there's probably some additional work in selling 1,600 units versus selling 60, or sorry, versus selling 600, right? So it might be more labor intensive and it's probably a lot longer day. It's probably a lot busier that day, right? So both actions result in achieving his stated profit objective. Raising the price meets his requirements exactly, but reducing the price gives him an extra profit of 20 bucks a day if it's worth selling, that much volume. This is what dollar stores usually do, right? So his choice would be a matter of personal preference. Both are feasible. So existing situation, right? A shortfall of 45 bucks. We're requiring 300, and we're just simply not achieving it. And then option one, right, increases our margin by $45, right? So we have the effect of the decrease in volume. So by selling less volume, we take a hit of $75, but by selling at a higher price, aka 20 cents per unit, we have a gain of 120. So the gain of 120 less the volume hit of 75, it gets us our net $45 increase, right? Whereas with option two, now, with the increased volume, right? So the 1600, so basically the 750 additional units multiplied by the 30 cents, we're getting a $225 increase, right? In contribution margin associated with the increase in volume. But we're going to take a $160 hit, right, on this because we originally would have basically, you know, sold for 80 cents, but now we're selling for 70 cents. So we're taking a 10%, or sorry, 10-cent hit in this case, right? So this causes a 160 hit. So the 225 gain on the increased volume less the 160 loss on the drop in price gets us that $65 gain, aka the difference between making 120 on this one versus making 140. Here's that $20 difference between 45 and 65, right? So Tony is considering the effect of advertising on his outlet at a cost of a mere $60 per day. He can have posters put on all of the transit stop benches within 1 kilometer. Okay, so he's going to do some additional marketing here of his place of business. If he does that, he estimates that his sales will increase by 250 units per day, and his current fixed cost is 180 per day. And at this contribution margin of 30 cents per drink sold, we can do the following analysis. So we are going to generate an extra $75 per day, right? So we're only going to do the incremental, right? We're already earning the other stuff. So we're only going to focus on that incremental, say 250 units. So if we do this, we're going to sell 250 more units and we're going to sell them at 30 cents, right? This is going to get us an extra 75 bucks a day. But we are going to incur an additional $60 per day. So the $75, gained in contribution margin, less the $60 in additional fixed costs, we're basically going to make an extra $15 every single day, right? So advertising increases his net income, so it is a sound business idea. And we should also recognize that it makes his business a little riskier, right? Because his break-even point is now going to be higher, right? So because we're raising the fixed cost from say 180 to 240, naturally, right, it's going to take more contribution margin to break even on his operations. If Tony has zero sales in a day, maybe there's a storm or something like that, right? His loss isn't going to be 180, right? With the additional 60 bucks, now his loss is going to be 240, right? So it does make him riskier. His leverage goes up, right? But with increased, fixed costs and increased leverage, he has the opportunity to make an extra 15 bucks a day, right? With the increased risk. Higher risk, higher reward. So note that in this calculation, the existing situation is irrelevant and that none of the data about the existing situation enters into this decision, right? We're already earning that, base amount, right? So now we're only looking at the incremental increase here. The only relevant facts are those that are marginal to the decision, aka the marginal increase, right, as resulted, aka the 250 units additional that we're selling. So the increased advertising spending is a marginal cost. The increased contribution, from additional sales is a marginal benefit. And then the net effect is the marginal benefit of the decision, which is that $15. So cost structure and operating leverage, in the prior example, Tony's advertising decision increases the fixed costs and thereby the break-even point for his business, which makes his venture slightly riskier. This brings us the concept of operating leverage, which looks at the company's cost structure. So meaning the portion of fixed and variable costs to assess the sensitivity of operating profit to the changes in sales volume. So if our sales volume goes up by 1%, what percent does say our profit go up by, right? So a cost structure with a relatively large portion of fixed costs has a high operating leverage, just like a cost structure with a low portion of fixed costs would have a relatively low operating leverage. So meaning that changes in sales volume have a greater impact on the company's profit. So in summary, a cost structure with a large portion of fixed costs has a high operating leverage, meaning that changes in sales volume will have a greater impact on the company's operating profit. Whereas cost structure with a low portion of fixed costs has a low operating leverage, meaning that changes in sales volume have a smaller impact on the company's operating profit. So it is called leverage because the fixed cost portion amplifies the effect of changes in the sales volume, right, on operating profit. Unlike variable costs that rise and fall in line with fluctuations of sales volume. So fixed costs are, constant and do not change with these fluctuations. As a result, when sales volume increase, right, having a large amount of fixed costs amplifies the resulting increase of operating profit. The idea here is that basically when you increase your fixed costs, your variable cost per unit should be less technically, right? Because what you're doing is, say instead of, filling this boardroom that I'm in, filling this boardroom with a whole bunch of workers that are basically assembling units, right? Instead of doing that and having that high variable cost, which is their hourly rate, instead of doing that, buying the machine that fits in this room and then just paying the fixed cost in that machine, right? So that machine is going to have a much higher fixed cost because I'm going to have to buy the machine, then I'm going to have my depreciation, right? And maybe my fixed cost is, $500, right, per day. Whereas, my fixed cost on a whole bunch of people in this room would instead just be like maybe like $20 for the lights, right? And then, if I had a whole bunch of people working in this room, maybe my variable cost is like, around $400, right? Whereas if it's a big machine, my fixed cost can be $500 and then my variable cost would maybe only be like $20, right? So it's the idea that as I increase my fixed cost, my variable cost will decrease, right? Well, as my variable costs decrease, I'm going to have a higher contribution margin, right? So as my sales are lower, it's going to have a bigger effect on my bottom line. But as my sales increase, I'm going to have that higher contribution margin, and therefore it's going to have a higher impact on my bottom line. And that's the concept that they're trying to basically get at here. So operating leverage is calculated by dividing the contribution margin by the operating profit. Contribution margin, say in this case, is 30 cents per unit, and daily fixed cost is 180. So expected daily sales, at 850 units, resulting contribution margin would be 255 units. Take off the 180 in fixed cost, that is basically resulting operating profit of $75. So what is the relationship between our contribution margin and our operating profit? Well, in this case, it's 3.4, okay? This means that a percentage increase, right, in sales volume translates to a 3.4 times increase in operating profit. Interesting. So if, say, our sales volume goes up by 1%, this ratio means that our operating profit would go up by 3.4%. If our sales volume went down by 1%, our operating profit would drop by 3.4%, right? So it's how leveraged is our bottom line? By leveraged, right? How many times more does it change based on, say, an increase or decrease in sales? So with Tony's example continued, operating leverage, $250 in contribution margin, divided by $75 in operating profit equals 3.4. So sales volume increased by 10% to 935 units. Tony's business will increase a 34% increase in operating profit, right? Because 34%, right, is 3.4 times the 10% increase in sales. So operating profit will be, say, 105, which is 75 times 1.34, right? And then where basically we see the effect of leverage. So the increase in operating profit would then be basically 3.4 times the percentage increase of sales volume. So however, say if sales volume decreased by 10%, the operating leverage will amplify the decrease of operating profit, right? And therefore our operating profit will drop by 34%, right? So in this case, right, so if we go, 1 minus 34%, right, 0.34, what we have left is 0.66. So our operating profit would be 66% of what used to be. So if we go to 75 times, the 66%, our operating profit then drops down to 49.5, right? So one case, our sales goes up by 10%, operating profit goes up by 34%, 3.4 times. But if our sales volume drops by 10%, our operating profit drops by, 34%, which is 3.4 times. So hence, it works in the opposite direction as well. You do well, you do really well, right, with the leverage. But when you have a bad year, you do really bad, right? And that's the risk you have to take when you increase the leverage of your company to basically drop the variable cost per unit. It increases your sensitivity. So contribution margin ratio, the explanation above works really well when there's a company selling a single product. Tony was selling only say soft drinks, and all the products had the same cost per unit and selling price per unit. So cost volume profit model fits his business really well because he's only selling one unit, right? And we'll have to factor in the 80 cents, 50 cents, 30 cents contribution margin. Fixed cost 180. It's very simple because one product line. In reality, most companies sell a range of products, right? They're not all at the same contribution margin. They may all have say different selling prices, for these situations. We can have a variation of the simple CVP model, and instead using the CM per unit, we can basically use the ratio instead, right? So what's the average contribution margin ratio that we have across all of our units? So for this example, we're going to use basically a company called Joe's Kitchen Store, which sells kitchen appliances. So Joe's Kitchen Store sells stoves, fridges, freezers, etc., and then also smallware as well. This includes, say, knives, gadget, dishes, and then when he buys goods, he adds a markup on cost, on average of about 25% to get to his target selling price, right? So he starts at the cost, increases that cost by basically 25%, and that's how he goes from what his cost is up to what his sales price is. So a stove that he buys for say $400 would be sold for $500. Why? Because $100 is 1/4 of 400. So if I multiply 400 by 1.25, it'll get me from the $400 up 25% to my sales price of $500, right? Conversely, that means I have a gross margin of $100, per unit. And if I go that $100 divided by my sales amount of $500, I would then have a gross margin of 20%. So markup 25%, gross margin 20%. So a 6-inch knife that he would buy for say $10 would have a $12.50 sticker price, right? Because say 25% of $10 is $2.50. So I add that $2.50 to my cost to get my price of $12.50, right? This would include that $2.50 contribution margin, because the contribution margin is very simply the difference between the $12.50 sales price minus the $10 in costs per unit. So all the contribution margin for the two products are different in dollar amounts. They're a constant percentage, right? So even though when I sell a stove, I make $100 in contribution margin, and when I sell a knife, I make $2.50 contribution margin, it's still at the same rate. It's still at the exact same rate of 25%, right? Even though it's different per unit, it's at a 25% rate, and I can use that 25% when I'm still doing these calculations, right? So it's a constant percentage of the selling price, and the contribution margins are going to be 20%, right? Because $2.50 divided by $12.50 sales is going to be 20%, just like $100, right? And basically, contribution margin divided by $500 in sales is basically also going to get me 20%. So it's constant between the two, units, even though that they're sold at different prices, vastly different prices and vastly different contribution margins. So using the contribution margin ratio to set basically a sales target. So Joe's Kitchen Store, right, has a markup on cost of 25% and a contribution margin ratio of 20%, as we've talked about. He has fixed cost per month of $100,000. He has break-even sales of basically, $500,000. So if we take that $100,000 in fixed costs and then we divide it by the 20% contribution margin, right, ratio, what we get is $500,000. So therefore, what his expected profit would be basically $10,000 per month, right? So his required sales to achieve this, right? So if we want to basically figure out what does he have to sell to achieve a $10,000, profit per month, we take those fixed costs of 100, right? Just like we did over here, but instead of 180 plus 120, we go to fixed cost of $100,000. We add on the $10,000 to get 110,000, right? Because that's total what he has to make in contribution margin. Then we just divide it by the 20 cents. And when we do that, that means he has to basically generate $550,000 in sales to generate $10,000 in profit per month. So Joe's Kitchen Store's current position is as follows. His sales per month is $520,000, so it looks like he's in pretty good shape. Or wait, no, he needs to generate 550, so not so good shape. His contribution margin ratio is 20%. His fixed cost per month is 100,000, right? So his operating profit in this case is 4,000. So although the business has been good, right? He's looking for ways to increase his profit because his target profit is about $10,000 and he's only generating 4,000. So he's got about a 6,000 shortfall from where he wants to be. He has three proposals on the table that he needs to evaluate to basically determine what's the best way to go forward. So consider an advertising campaign that would cost 15,000 per month. Okay, so we're going to go from 100,000 to 115,000 per month, right? But we're going to forget all of this because we're only going to do an incremental analysis at this point, right? So we're only going to look at what's changing. So what is changing here? And with respect to our bottom line, we're going to take a $15,000 hit per month on our bottom line because we're increasing our fixed costs, right? But we're also going to increase our contribution margin, right? Because we're going to increase our sales, and we know that contribution margin increases with sales. So if we are generating a contribution margin of 20%, right, on those additional sales of 100,000, we're basically in that month generating an additional contribution margin of $20,000. So we generate $20,000 in additional contribution margin, but our fixed costs increased by 15,000. So what we have left over is an additional, $5,000 for our bottom line, right? So it increases our profit, which is pretty good, right? Our increase in contribution margin exceeds the increase in fixed costs, right, on a marginal basis, right? So this idea increases profit, so it is technically acceptable. We were targeting 10,000 per month. We're achieving 4,000 per month. If we add this on, we'll now achieve 9,000 per month, 4,000 plus the 5,000. We won't quite hit our target, and we know that we still have two additional options on the table, right? So what we're going to do is, yes, this does increase our bottom line, but we're going to continue on and evaluate the additional options because it's a good idea to not stop at the first one and do a holistic valuation. So Joe's current sales are 520,000 per month. And then so considering the effect of introducing a new sales commission program that would reduce the contribution margin from 20% to 19% on sales and increase sales by 250,000 per month. This is a very interesting one. So we're not actually adding any fixed costs whatsoever, right? What we're doing is we're sacrificing 1% of our contribution margin, right? So instead of making 20% on average, on our sales, we're only going to make 19%, right? Because we're going to give that extra 1% to our salespeople in commission, right? And as a result of giving our salespeople an extra 1% of commission, right? What they're going to do is they're going to generate an extra $250,000 in sales per month because of the incentive, right? So now we have to do our analysis, right? We are going to lose 1%, right, on basically our existing $520,000 in sales, right? So 1% of our existing $520,000 sales. So we're going to lose $5,200 in contribution margin on our existing sales. And our fixed cost is not going to change. So we're taking a $5,200 hit right now, okay? But we're going to see an increase in contribution margin at the increase in sales, right? At the increase of additional $250,000 in sales we're going to make per month, right? At the 19% contribution margin, our new contribution margin, right? So we're going to see an increase in total in contribution margin of 47,500. So we go to 47,500 minus the lost contribution margin, right, on our existing sales of 5,200. What we have left over is 42,300. And this is our net increase in operating profit. We're already making about 4,000 a month, right? And our target's 10. With this, oh dear, we're going to be up in the 47,300 territory in profit per month, right? So the other one was pretty good, but this one looks really good, right? Especially, we're not even getting that much more risky because we're not even increasing our fixed costs. We're just slightly dropping our contribution margin, but in exchange, we're greatly increasing sales because of the increased incentive. So let's look at our last one. Option 3, consider the effect of raising prices so the contribution margin ratio increases 22%, so increase our contribution margin by 2%. And this will cause our sales to drop by 10%, right? Because we know when sales increase, demand tends to decrease, right? Sales price increases, demand tends to decrease. So fixed costs, in this case, it's not going to change in the slightest, right? Because we're just messing around with what our contribution margin is. So our contribution margin lost on the decreased sales, right, is basically going to be, so 10% of our existing 520,000, right? That's how much our sales are going to drop. And then multiply that by our existing contribution margin, right? So in total, because we're going to lose basically, 10% of the 520, that's going to equate to about $10,400 lost, okay? But we're going to see an increase in the contribution margin of what's left over. So in the above, our sales are dropping by $52,000, which is 10% of $520,000, right? And we're losing $52,000 in sales, and currently we make 20% on those sales, right? So that's where the 10,400 is coming from. But, right, on the remaining sales, the $520,000 less the $52,000 in sales that, right? So that leaves us with, I hate doing mental math, but I believe $468,000, right? That's what we have left over. On that leftover $468,000, we're going to make an additional 2% contribution margin, right? So that equates to an additional $9,360 in contribution margin. So we're losing 10,400, we're gaining 9,360. That's a net decrease in operating profit of 1,040. So if we take this option, we're actually going to go down from 4,000 to basically we're going to be only making $2,960 per month, right? Which is a hit. So this is definitely not a keeper. This one's bad. This one's really good. This one's okay. So chances are, if you're watching this, you're going through it, probably thinking, option 2 is probably the best one, right? We're going to make so much money per month. And, based on this analysis, you're probably right. So in the above example, Joe's Kitchen Store applied the same 25% markup on each of its products, leading to the same contribution margin ratio across all products. However, different products often have different contribution margins, and as a result, different contribution margin ratios. So which contribute to, which contribution margin ratio do you use, right? If, one's say 30%, one's 10%, right? Instead of, my knives having a contribution margin of 20% and my appliances having a contribution margin of 20%, because in most cases, like, that doesn't happen. Usually all your different product lines usually have different contribution margins, right? So when you're dealing with, it's not perfect and they don't all have the same contribution margin, but you're dealing with a whole bunch of different contribution margins, what you have to do in this case is you just take the weighted average contribution margin and use that. This is what it looks like. So Joe's Kitchen Store basically achieves a contribution margin of 30% on kitchen appliances and 20% on smallware items. So its sales mix based on total sales dollars is 40% kitchen appliances and 60% smallware. Okay, so we're basically 40% of our sales is going to come from our our kitchen appliances, and then 60% of our sales are going to come from like knives, forks, stuff like that, right? Assuming that $100,000 in monthly fixed costs are shared across the products, how much sales dollars must Joe's Kitchen Store generate to break even or earn a profit of $10K per month? Okay, interesting. And so basically 40% kitchen appliances, and on those kitchen appliances, we earned a 30% contribution margin. Their sales are going to be 60% smallware, and on that 60% of sales that is smallware, we're going to basically earn a contribution margin of 20%. So we have to factor this into our analysis. Step 1, what we have to do is basically derive the weighted average contribution margin ratio. So the weighted average contribution margin ratio is going to be basically, okay, what is our contribution margin, right? And then what is the weight of the product line? So our kitchen appliances do 30% contribution margin, and 40% of our sales come from kitchen appliances. So we put that together, 30%, times 40%, right? And then we take our contribution margin ratio on smallware, right? And we multiply that by the 60% sales mix. 60% of our sales are smallware, right? Multiply those together, right? And then we add them together, and that means that our weighted average contribution margin, if we have a 60-40 sales split at 30 and 20% contribution margin ratios, overall across our entire organization at that split, we're gonna have an average weighted average contribution margin of 24%. So step 2 would be then to calculate the break-even sales using this weighted average contribution margin ratio of 24%. So we would basically go, same fixed cost divided by our contribution margin. So fixed cost of $100,000 divided by our contribution of 24 cents per unit. That means we'd have to basically generate $416,000 in sales. Well, now you're going to say, okay, it's $416,000 in sales, but how much of that is kitchen appliances versus smallware, right? Well, then we just reverse engineer the formula. So we take that 416,000 and we multiply it by 40%. And because 40% of our sales are kitchen appliances, to get the $166,000 in sales that has to be kitchen appliances. And then we know that 60% of this 416 is going to be smallware, because 60% of our sales is smallware. So that means $250,000 is going to basically come from our smallware division, and add together, right? We get the total of 416. So we split it out based on the sales mix percentage. So as a functional manager, like in service cost centers such as human resource department, the effective cost behavior may lead to misleading interpretations of the department's efficiency, right? So almost all the costs of human resource department are fixed costs, right? And if sales revenue and production activity is rising, then the cost of human resource department per dollar of sales revenue will fall. And this could be interpreted as greater efficiency, even though the actual cost of the department had not changed. So conversely, if sales revenue falls, the cost of the HR department will become greater percentage of sales, right? Because if something's fixed, when sales goes down, well, that becomes a bigger proportion, right? But if something's fixed and sales revenue goes up, well, that becomes a smaller proportion, right? So it becomes misleading when we try to apply this to a fixed cost situation. So in this, in summary, we've discussed the behavior of variable fixed costs, revenues. We've also talked about a little bit of mixed costs. We've talked about, break-even models. We've talked about, cost, volume, profit. Very, very good if you're trying to start a business, right? Not as useful if you're specifically managing more of a fixed cost apart, right? It does get a lot more complicated in activity-based costing, right? But as a basis, this is a great base knowledge and understand cost behavior and how it can be applied to a business. I want to, sincerely thank you for sticking with me. Hopefully you didn't watch this on 2 times speed, and hopefully you picked up everything we've chatted about. And of course, if you have any questions, just let me know. My inbox is absolutely always open. And yeah, I look forward to our next class. Thank you very much.